Good afternoon, everybody, and welcome to a very special episode of GameChanger Conversations. I must confess we have not been able to do this on a very regular basis in the last 12 months because work gets in the way. But today we've got a really special guest with us who's kicking off our latest season of GameChanger Conversations. We're going to be having multiple conversations with experts in the industry on issues that confront startups. And kicking off this series is Mr. Vishesh Rajaram. Vishesh happens to be a very close friend personally and of the firm as well, and has been an ardent supporter of GameChanger Law Advisors for more than a decade now. But going beyond that, he's here for a very specific purpose today, which is to help demystify, for the benefit of founders, startups, and other interested parties in the startup ecosystem, certain concepts in venture capital investment term sheets. Vishesh is eminently qualified to be doing this conversation with us for multiple reasons. One, he's been in the venture capital industry for 13 to 14 years now. He was previously with a very reputed growth stage venture capital private equity fund called Venture East, which made a number of investments and continues to make a number of investments in the Indian startup market, has been doing so for the last 2 decades, if not more. Vishesh spent close to a decade there before he moved on to set up his own venture in the fund space by launching a seed stage investment fund called Speciale Invest Fund. Since launching Speciale, Vishesh and his team have made a number of interesting bets on early stage startups operating in multiple industries. These range from startups operating in the space tech space, cloud computing space, in mobility, in electric vehicles, and also in gaming startups as well. And we've also had the pleasure to work with Vish on some of these transactions as well. With those kind of credentials, I could not think of anyone more qualified to actually delve into the conversation that we're going to go ahead and have in the next 30 to 45 minutes as well. Vishesh also can equally play the role of a founder as well. He was actually involved in turning around his family business before he joined Venture East as well. So welcome, Vishesh. Thank you so much for agreeing to do this conversation with us. And we're really looking to have an exciting conversation with you during the course of the next 30 to 45 minutes as well.
Amrut, I must firstly thank you for such a glorious introduction that you've made. I wish a lot of that plays out in the future. Thank you very much. I'm very excited to be part of this working session with you to share my views and also learn from you.
Actually, I think, Vishesh, what we can do first is to outline for our viewers or listeners the context, in which I reached out to you a week back to do this conversation. I actually happened to read a very interesting piece written by a current venture capitalist and an ex-partner at Accel as well, called Fred Destin, who wrote this piece called VC Barbarians Are Coming. What stood out for me was the usage of the term barbarians alongside venture capital investors. And more so coming from a practicing venture capital investor, I found that to be very interesting. I also found that to be, from personal experience of having advised both investors and founders, the word barbarian seemed a little harsh. And I guess this sort of plays out in economic environments that are stressed, pretty much like the environment that we possibly are operating in today. We'll more about that later in the conversation as well. That was a very interesting phraseology. I just wanted to get some initial thoughts on that, and maybe you can help us either validate or debunk the theory that has been proposed by Fred. Would be interesting to know,
sure.
As an investor, do you consider VCs to be barbarians?
So I think VCs have a very complex life ourselves, right? We as you know, are managing somebody else's money, running our own investment strategy out of it, and investing in companies. I think in stressed environments, in the context that you have said, humans tend to behave more driven by their emotions as well as their past actions. And hence, I'm sure there will be a few moments where VCs possibly will come with down rounds or pay-to-play rounds in situations where either the company's operating environment or the company itself in the way it has operated has drastically changed. But particular to these situations and more particular to a more later stage when, when there is a lot more clarity. I mean, for you to behave in a very decisive manner that appears to be harsh / barbarian, you need to have a great amount of clarity. You need to have clarity that something is terrible, something terrible is about to happen, and hence take that action. And I think we may end up seeing some of these in more later stage environments or in environments where the operating assumptions have changed.
Okay.
Having said that, barring one or two cases, I haven't seen this play out. I mean, the only case that I recently read was Uber's sort of investment in Lime, where they sort of led a $170 million round and brought down the valuation by about 85%, if I read that right, at the Information's blog. And I think you'll have those situations. There are, and like Chamath, famously said, there are price takers and there are price givers. If you're a price taker, then it is what it is.
Interesting perspective, and I think we'll get to understand the VC's perspective in greater detail as we go through the conversation as well. That sort of was the context. Let's start this conversation by just understanding some of the macroeconomic indicators. Obviously, it's now been 2 to 3 months since the world woke up to this pandemic. The world is still counting the costs, both human and economic, of this pandemic. And so therefore, would it be safe or obvious to state that we are in a recessionary cycle for the next 12 to 18 months, where the world as a whole is going to have to grapple with some terrible economic consequences, and come to grips with the challenges that lie ahead for us as well?
Let's understand the backdrop to this. We got a world which has both developed economies and developing economies. We've got a world that has spent the last 10 to 15 years significantly believing in the concept of globalization, which means that if some other country is better doing something than me, then let's try and get most of the work done there, right? And we've largely enjoyed the fruits and efficiencies of that in the last 10, 15 years. Now is a time where there's a big pause on just movement of goods from anywhere to anywhere. That's one layer which is now affecting trade. Of course, that has a domino effect in terms of if goods aren't there, then there's not enough economic cycle in these industries. And if there is not enough economic cycle in these industries, consumers are not buying, the employees are not making enough money, and hence there's a ripple effect that sort of then travels down into the human layer, right? So this is just the economic side, but the economic side here takes precedence because there's a social and humane side to this, which is taking the front seat of the problem, which is that people are falling sick, people don't have insurance, the infrastructure in many countries is either lacking or not sufficient. And all of this, of course, is leading to a lot of chaos and confusion over and above all of this. So naturally, a lot of the developed economies have slipped into recession from what I read, but the UK is clearly out there. What's important to watch out is how quickly this bounces back. But if we were to take the example of whatever little data we have from previous pandemics, I think 12 to 18 months is a very fair assumption to keep as the time frame for us to possibly look at exiting this environment. But I think in all the time between now and then, we are possibly either in a recessionary environment for certain geographies, and for certain other geographies, we're definitely slowing down. There's no two ways about that.
All right. All right. Okay. And with that macroeconomic environment that everyone is grappling with, let's first specifically talk about your industry, which is the venture capital industry as well. And we'll also talk about the other side of the industry, which is the founders and the startups, who are an integral part of, how your industry performs as well.
Absolutely.
Yeah, a latest EY report has forecasted that India is probably going to see a dip of around 60% in venture capital / private equity investments in India in 2020, largely due to COVID-19. Does the evidence of the first 4 months of the calendar year bear the EY report out? And that's more at a macro level from your industry standpoint. And more specifically from Speciale standpoint, how has the year been till now? And what do you see are some of the indicators for Speciale itself in terms of how it looks at investment opportunities, whether in your existing portfolio companies or if you're actually going to be being brave enough and looking out for new investments in this environment as well?
Interesting. So I think there are two parts to this, right? One part is let's just let me throw a little perspective on what I think will happen. I think, and there are a couple of layers even there, and I'll talk about them in just a moment. The more front-facing layer, which is what do we expect VCs to be doing? Do you expect them to be writing a lot of checks or not? I think a natural human behavior at this point of time is going to be to avoid risk or be risk averse. Of course, now you need to see that relative to the lives of VCs. We live with risk. So when you mean risk averse, we don't mean no risk, but we just mean less risk. And in such environments, I would believe that capital will continue to sort of flow into more later stage companies. Because again, the risk is a little more predictable than it is for seed companies. There's revenues, there's customers, at least there's some more data to sort of quantify risk rewards.
Right.
But clearly the seed, the pre-seed, sort of that particular stage will take a big beating. I now would sort of quote this GP from Redpoint called Thomas, and he's got a very interesting blog that he wrote. And he essentially looked at data between 2008 and 2011 across seed A, B, and C rounds. And I think the data, and I'm just quoting what the data showed. The data showed that seed was the first to sort of fall, freeze, spiral down over the first 3 quarters starting 2008, 4 quarters. What is interesting to know is also purely in terms of volumes, they were also the first to sort of, I wouldn't use the word bounce back, but climb back up. Now, if I were to try and decipher that from just common sense standpoint and apply a paint of risk on it, I think human behavior at this point is going to be risk averse. So anything that appears too risky, you will walk away from it, which means that you will do less to no seed deals, right? And when you start feeling better and when you start feeling like you want to come back and start making some of those bets, naturally you want to start small in value. And you can't, write a $500,000 check into a Series C round. So you would end up writing a $500,000 check in a seed round. And that's how they pick up back up. So I would see that sort of playing out. And the early evidence of this theory lies in what CB Insights quoted for its Q1 in North America. And I think the guidance for the first quarter is very much in line with what Thomas quoted, which is that seed will be the one to see the most steepest of falls to begin with.
Okay.
So that's a view. Now, the positivity here, I would like to assume, and I use the word assume, and I'll explain that as well, is that there's a lot of dry powder. I don't have the exact numbers on India, but India, I'm told, is again in the billions of dollars. I know a country like America possibly has about $157 billion of venture money. That's a good enough dry powder. And if I would extrapolate that or linearly put that to India's size, I think there's enough dry powder sitting out here. Mm-hmm. And hence, The goodwill statement I'll make is good companies will get capital slowly and steadily over time.
Right.
The layer of complication in this, however, is let us not forget that all our money are uncalled money, and uncalled money essentially depends on the liquidity of the LPs.
Right.
And each one of these LPs are having their own interesting times. I heard that the Norwegian fund is having an interesting time because they're having a huge cash call out to make sure that enough money goes to the government. Similar with Saudi Aramco. Now, I don't know the impact of that on the Middle Eastern money. There have been notes on both CalPERS as well as a couple of other California county pension funds that they're all sort of planning for cash call outs. What that means in terms of creating liquidity, what that means in terms of honoring capital calls, etc., is not easy to decipher from where I am at the moment. But those are some of the variables that will play out in the future. The good news is that the venture community is mature. We have data from the past. So I think fund managers will be smart to make sure that they also manage their cash flow statements in terms of when they'll draw, where they'll invest, when they'll return money in a slightly more nuanced manner, because it has what's called a bullwhip effect across the value chain.
Okay, I think some really, really interesting insights in there, in your opening remarks already, which also leads me to the next few questions. So one, what I clearly hear from you is that seed stage activity will definitely be muted for the next couple of quarters at least.
Totally.
Yeah, unless the indicators start to improve, you are going to see a more difficult time for early stage startups, right? And I think, the question arises then, the 60% drop, is that a fair number to peg at this particular point in time, which therefore means that founders are going to have very, very limited options. And even amongst founders as well, you will have to be discerning enough to know founders that have good business models, founders that have, would have been funded in a normal environment, but may not make the cut in a difficult environment. And then there are, founders that are on very, very shaky business model ground in that sense. So personally speaking for Speciale, how do you look at founders in this environment? And when you say, if I had to take a bet on a founder at this point in time, what are some of the traits that they need to possess, before they can actually attract your funding?
Yeah, I'll answer that, but I'll also answer the question that you left behind in the previous one, which is what are we doing at this point of time?
Right.
I think like most other people, of course, we have to look inside the house first just to make sure that everything is okay and everybody's okay. And a large part of March, and we caught on to some of this early April, sort of allowed us that time to sort of recalibrate businesses, recalibrate plans, look at runways. And I must confess, I think the entrepreneurs we work with, and I think in general, the entrepreneurs that are out there have shown tremendous resilience in budgeting what's going on into their lives, both professionally and personally. At least for the 15 plus founders that we work with, I have tremendous respect for just how they behaved in this environment, sort of been very pragmatic, put business and survival right in the front, of course, with employees, and sort of rebuilt and recalibrated themselves. 90% plus of where our dollars sit have now runways upwards till end of 2022. So I think that was one thing that we sort of did. We wanted to make sure that the house is in order, the founders have a direction. In a couple of situations, needed some more capital, and we did bridge rounds between us and some of the other internal investors early on to sort of do it. I think the lesson here is it's good to be conservative, and it's good to sort of be pessimistic in some of these assumptions you make, and it's good to load up cash. In terms of doing business, I must say, as much as I do a lot of Zoom calls, doing a deal over Zoom, we haven't done that yet, but we will learn to do that over time. We're a seed, pre-seed investor. At the time we come in, our ability to understand the founder, relate to the founder, is very, very high. And we're quickly learning, find a way to do this without being in person. But we'll get there. We continue to be in business, and I'll caveat it. I think we have a few founders that we have been tracking. We've been in engagement now for 6, 9, 12 months. And hence they possibly sit right on top of probability of deals that we'll do, just because we have a lot more data on them. Having said that, we're also being very pragmatic. I mean, we have more than half the fund in dry powder, thankfully. We're being pragmatic to sort of make allocations for follow-ons, and we're being pragmatic to see what kind of bets we'll make. Over the remaining life of the fund, we possibly will make about 8 investments. So we are in the business of making investments, but I think the yardsticks for what we're looking at and how we'll do deals is beginning to change. That sort of brings us to the question on, hey, what is it that we're going to be looking at if we're going to be doing a deal now? I think we're looking at a couple of things at a very fundamental level. One, our DNA as an organization has been very technology and disruptive technology oriented. And I'm carefully not using the word deep tech because that's now sort of become cliche, right? So for us, the problem that is being solved for needs to be radical, disruptive, fundamentally new, or the approach needs to be fundamentally new. The problem may already be there. And that sort of is the bait for us to spend time, right? And we're looking now for founders who sort of have either failures or resilience built into them. Because either of these is only going to sort of allow them to endure this very painful journey of being an entrepreneur, number one. And number two, being an entrepreneur at a time when liquidity is not flowing easy. Liquidity is not scarce, but it's not going to flow easy.
Yeah.
Right? Of course, one of the ways we judge this with our founders is we tell them that, hey, the same capital, you either got to give an order of magnitude higher outcome, or if you're aiming for the same outcome, you've got to take an order of magnitude lower capital. I mean, if the whole world is sort of beginning to live more frugally, your expectation is, the expectation on you is a lot higher. And I think those are sort of what we're looking for. I mean, we're still big believers of backing very disruptive technologies. We've backed companies 4 years ago that were doing battery tech. We back companies that are building rockets. We back companies that are building robotic arms. I think we'll end up doing more of these as long as we find the right kind of people whom we think we can relate to and work.